What's going on, guys? Thanks again for sending in the questions for the Sunday morning mailbag. This is our second one, and we're coming off pretty much the hottest month of the year, at least for me, and I would probably say that the chat room as well, which was August. And it's really a trader's market right now. There's so much availability each and every single day. There's a 50 to 100, maybe even 200% gainer every day. And if those aren't good enough, then the market's swinging 100, 200, 400, or 500 points on any given day. I think the best part about this market is you don't need to have just one strength. You don't need to be a good shorter. You don't need to be only good at going long. You don't need to only be good at trading ETFs or options or anything. There's been so many different types of plays available each and every day. You can almost pretty much take your pick and focus on where your strengths are. And what a lot of people do is they try to nail every single stock that's out there. They see 5 or 10 stocks that they want on scan that potentially could be easy plays or good setups, high reward, low risk type plays, and they try to get them all. But what is very important in this market is to focus on just a couple. That might be 2, that might be 3, that might be a max of 5. Whatever is good for you and that you can control, that you can watch all at once, that you can be able to get in and out when you need to, that should be your max. And what I've been seeing, and I'm sure a lot of you guys have, some of the guys that post what they've been trading for the day, you'll see that most of the trades or most of the profits are made in a couple names. It's guys that are trading maybe 2 or 3 names on a daily basis. They're just waiting for that perfect setup. They're waiting for the perfect entry. And when you have the right entry, that gives you the ability to be patient and let the trade work for you. So I'll go through the same format as last time. Some of the questions that have been sent in are already covered on Tandem Trader. So like I wrote in the paragraph above, requesting the questions, if it's something that we cover and it's obvious that you haven't gone through the educational material that we offer, then I'm going to skip it, because there's people here that have purchased the streaming educational material that we've created, and this is a chance for them to pretty much further their education, and that's exactly what the goals are here. So the first question that I got in was, at what percentage gain or loss do you consider a chase? If a stock is up 30% or more, would it be considered a chase? And what if you see an ABCD pattern forming? Would you get in even if it's up so much, or are you already anticipating a retrace? And the same as if a stock is down 30%, are you already looking for a bounce? And the biggest or most important thing to understand about this is never think that a stock is up too much, and never think that a stock has pulled back too much. And anytime that you are considering a stock that's got large range, always take a step back and look, all right, is this thing up $2 a share, $3 a share? Well, if you're not okay risking 50, 60, 70 cents a share on that initial entry, then you're in too big. You should always take that initial entry based on probably about a quarter or a third of the range on the day. So if the stock's up $3, you've got to be okay with somewhere between 50 and $1 of either upside or downside from there. And if you're not, then you're not giving yourself enough range to let the trade work for you, because the reality is you're not going to nail a stock to the penny. I mean, you might over time, you might here and there, but overall, you're not going to nail the penny on the top or the bottom each and every time, and nor should you. So the best thing to do is just to go ahead, start in with a wide idea, and then as the stock works in your favor, if it does, then add in to there. And if it doesn't, then at least you're only in a very small amount. KBIO is a perfect example of a stock that did just that, where we had a big move from 2 to 3, almost up to 4 the first day. And then the second day, it started to open around 320. And you can see that on the 1-minute chart here, where it started to push up, then pulled back, started to push up again, pulled back, and it started to continue to hold trend from there. So a stock like this What I'm looking for is how does it react at any given base? When it starts to pull back, is it being absorbed? Is it starting to hold trend? Is it starting to push up and then pull back and then trap shorts and then head to the next level and so on and so forth? And if that is happening, if the stock holds out of the gate, for example, like it did on Friday, had a huge parabolic, and I was long anticipating a potential follow through of momentum. And so I ended up having about a 330 average, started to ramp up into the open as we anticipated based on, each dip you can see it was pulling back, get spot up, pull back, get spot up, pull back, get spot up. And as it started to get into the open, a lot of times we see that huge candle at the open where this one had about 500,000 shares, spikes up, always good no matter what, takes them off. And then you need to look at where the pre-market support was. So in this case, 330s is where it was pretty much consolidating, 320, 330. And if it starts to hold trend out of the gate, then you can go ahead and quote unquote chase that name, but it's not going to be your typical size. So a stock that was just 2 yesterday and now it's at 340, sure, my risk in my mind might be 320, 330, but I don't want to commit to something where I might typically trade 5, 10, or 20,000 shares, but I'm going to probably size down something like 1,000, 2,000, maybe 3,000 shares max. Something that gives me the ability to disconnect from the stock still and not really worry about the fact that it was just up $1 the day before, but gives me the ability to let the trade trend, let it figure itself out. And as long as it's holding trend, it's likely going to go higher because sentiment online, everyone was bashing it. And even the shorts on Friday, sure, they're going to be right in the long run, but they didn't make money on Friday. And a lot of people were loud about it. They were thinking like, this thing is garbage, this thing's pulling back, but they all started in under $4. And then at $5, you start to scratch your head and wonder, hey, is this thing going to pull back? And so then it finally starts to pull back. You can see that it went back under the VWAP, which I started to add the VWAP to my charts on Friday. And you can see late day, once it broke under, it retested, peaked out again, retested, lower high, and finally failed into the close. But shorts on this are still not up. They are likely even at best or down a little bit. And that's why it's still continuing to be extremely jumpy. Now, are they in need of cash? Absolutely. Is this a junk company? Absolutely. Is it probably going to pull back? Absolutely. But as you can see, it offered an awesome long opportunity followed by, unfortunately, a short opportunity that I missed. The main thing to understand here is a chase is never full size. You always leave room for error, but it gives you the ability to potentially catch a move that you would normally otherwise miss if the chart is set up for a breakout. And one other thing to keep in mind here is you always want to focus on former runners, stocks that we know have a history of running. First question from Jeff. First, do you scan OTC stocks as part of your nightly process? And if so, how is it different than your standard process? Honestly, not in this market. There's so much going on with NASDAQs and just the market in general that there's really no reason to overload what I'm watching. However, guys like Sandro, Tim Grittani, and even Modern Rock, most of these guys are still trading OTCs, and that could just be a simple scan of the highest percentage movers with volume. Obviously, you don't want to trade a stock that's up 500% on, 5,000 shares. You need to be watching for volatility, the range, just like everything that we do on NASDAQ. So definitely, if there's options, just like there was with AVXL recently, there's definitely opportunity out there, but it's not something that I'm scanning for currently in this market. I can't even keep up as is. Secondly, do you require knowing a company's float before you get involved in a trade? I notice the warnings you give to shorts are for the most part on low floaters, and was curious if you make sure you are aware of the details before getting involved, especially with conflicting info out there on various sites. So obviously lately we've had so many low float runners, and if you guys don't know what low floats are, then go ahead and either check out Tandem Trader or check out any of the free videos. Look up float rotation, just Google it, and you'll see a bunch of videos on it. But yes and no. It's not that hard to understand which ones are low float. You can just look at how they're trading. Are they jumping around 10, 20 cents at a time? Spreads of 5 cents or so? Are they moving from 2 to 3 on relatively low volume and then continuing to trend? That alone is going to tell you a lot of what you need to know. And at that point, if you're still curious, you can look. And if it's somewhere between 3 and 5 and 10 million shares, and even up to 20 million shares, if it's got the volume, if it's got a couple million pre-market, if it's got 10 million by midday, if it's trading heavy volume, and the float doesn't necessarily need to rotate, meaning if it's 3.5 million shares, it's trading 3.5, and then another 3.5, and then another 3.5. And I've gone over this stuff in depth, but not necessarily. I don't need to know the exact number. A lot of times you can just go ahead and take a look at it, understand it, and know that you need to be careful. There are times when knowing how thick a stock is could end up hurting you. For example, on PPMD, this one was one of the thickest names out there, but it traded like a low float. And the last question from Jeff was, lastly, during pre-market, are you looking at your watch list and scans, or do you have a centralized location that alerts you on tickers that are moving? So right when I wake up, I'm looking at the stocks that I have on scan and the highest gainers on the day. So just pull up the top gainers on the day. That's really all you need to do in a market like we have right now. But I check out what's on my scan. Is it gapping up like I was expecting? Is it gapping down like I expected? And if they're doing exactly what I expected, and then they have follow through volume, it's not just something that has 100 or 200 shares printed, but something that might be trading a couple 100,000 volume, I'm interested, because all I care about is liquidity. I don't want to be trading these illiquid stocks that are very easily influenced by just a handful of buyers. I want to be able to get in and out of a stock without worrying about liquidity. And then the only other thing that I'm looking at in the morning is the high a day and low a day list. So that gives you a little sneak peek of what's happening, what's running, what's pulling back. And obviously out of the open, everything is hitting your high a day and low a day scanner. But once the market opens, once it's been hanging around for 20, 30 minutes, that's when it becomes a little bit more important. And you can set up the scanner, you can view, and you really don't miss much as far as what's breaking out. Next questions. How do you focus on multiple charts and not miss an entry or an exit? The easiest answer here is, I don't know who told you that I don't miss an entry or an exit, but it comes with the territory. You're always going to miss entries and exits. Obviously, the more monitors that you have, the better. Every little bit helps. But if you think that you're not going to miss an entry or an exit, then you're living in some sort of dream world. The biggest key is to not have to flip through charts. If you can just have them all in front of you without having to move things around, without having to touch certain windows to be able to see the other windows, that's the key. Next question, are you making a third DVD? I'm not sure. I have no plans to at this time. My next step is to better what we already have, sort of making like an A to Z in the back end of the website so that members can really prosper. We've been slowly developing a new chat room, and I've been getting moderators more and more involved so that users can continually learn and be educated by different people than just myself. So that's really my priority right now, and in addition, it'd be pretty hard to top what we did on Tandem Trader. When do you know it's time for the next level where the person's trading? How does one know what the next level is? This has been a big struggle, but a worthwhile struggle for me. I had this conversation with somebody who left some comments on my blog asking me why I'm trying to up the stakes. And what am I trying to prove? Why do you need to change what you're doing? It was a point at which Greg had mentioned he doesn't understand wire out. And it's true. And it was something that I had always done because, I was trying to get myself in the best position long term to be able to do this long term. And it's what worked. And I never really ventured very far away from it, which is what I suggest for new traders. You always want to continue to wire out, and put as much money as you can in your bank account, because you really never know when you're going to have a cold streak, when you're going to run into a big short squeeze that you didn't anticipate and it wipes out part of your account. These are things that actually can happen in trading, and being able to give yourself the best chance you can is the most important. And as Modern Rock says, you only need to get rich once. So the answer as to why I have been pushing and why I have tried to get to that next level is just like an athlete. If you're good at something, if you're good at pitching, why wouldn't you get a private pitching coach to further your career, to give yourself the best chance at maybe getting into a college free ride, maybe getting into the professionals, whatever it may be? Why not invest in the best you can get, if obviously you can afford to do so? So that's the second part of this, is if you are in the position to take it to the next level, if you can withstand a drawdown, then you can start to think about, hey, maybe I want to up the stakes a little bit and start to push towards bigger and better opportunities. But the biggest key is to not change anything just because you decide one day you want to start playing bigger, because that's not what it's about. There's a lot of psychological and emotional twists and turns in it, and it's best to just keep on pushing as long as you can at the rate that you're going if it's working. In your experience, do SSR stocks have a higher chance of squeeze? The answer to this is not necessarily. As I go over in Tandem Trader, it's more about understanding how to trade them, staying away from crowded spots, anticipating into big strength, big breakout spots that end up failing with increased volume. Obviously, there's more risk involved if you're anticipating into a pop, but the best way for a new trader is to wait for that move to exhaust, start to pull back, and then start to short on pops. Because what that allows you to do is two things. Number one, risk on the high day, or number two, once you've started in and you've added a little bit, you can risk on the recent high. So it gives you that educated risk that you need in order to trade with a set plan. The next question deals with WaveX and how do you trade illiquid names as opposed to things that are actually very, very tight and trading a lot of volume. Each of the candles are next to each other rather than just jumping all around the chart. And typically, I don't trade stocks like WaveX. It's not something that I'm really interested in, and I didn't trade this particular name. I saw it on radar, but I also ignored it for the same reasons that you've mentioned. Things like that is best to work on an entry and not get excited or not fear that you're going to miss a particular move. Because if you're fearful that you're going to miss the move, then you're just really acting out of emotions, and it's sort of the fear of missing out. So it's always best to just wait for a stock to pull back, wait for that opportunity, and a lot of times you can decrease your risk by working on the price that you purchase it at. From Ash, what do you think the reasoning, macroeconomics or whatnot, behind why BVXV went down so easily without a fight? Pre-market was kind of the one in play with major volume. My thinking was, since it was day one, had 2 million float, and it was the only one that had pretty much action pre-market, that it definitely would have continued to run. Do you think it was crowded long squeeze out of the open, was preparing to be long bias in the don't short gapper sense? Really confused on this trade. So I'll touch upon this briefly, but we went over it in depth in the last webinar quite a bit. But the idea in the trade that I made being short was that it had gone up so quickly so fast without any real pullback, any real retest on the dips that gave an opportunity or a reason for longs to really panic or sell or take profit. So sometimes when things go straight up and everybody's just buying every single dip, I start to look for how they react when they approach certain spots where they're about to either break out or, in this case, stuff. So BVXV was a great trade. It ended up being a really big gainer for us. But what I was looking for is how easily it trended up, had a higher low, started to grind, continued to go, and it went from 480 to 580 pretty much on air. Pulled back a little bit, continued to go, but you'll start to see each time it was about to break out, it kind of sat back. And it seemed as though there was a decent seller around this 570 range based on these candles. And each time that it popped back, that 570 area refreshed. That was the first thing that got me looking at it. And then the second one was, how did it react to the whole number? And as you guys know, we focus a lot on whole and half dollar marks. So this started to push up and it went through the 590s and it peaked out. And at that point, if it's going to break through and squeeze through 7, there's a good chance that 590 would start to hold and then just break right through 6 and jump towards 610, 620, something like that. Well, in this case, it kind of just stuffed a few times and then it started to have lower highs. 590 started to be the peak. At that point, I had suggested that I'm going to look for it to dip, retest towards the 590s, and if it didn't break out, if it was met with volume and it failed, then you can go ahead and get short based off of that 6 over and under as that mental stop, that guide. So that's exactly what happened, and started short on the pops, anticipating a pullback towards that next whole and half dollar mark, which was 550s. And then not only did we have a little bit of padding because we were able to lock some in on the dips, but out of the open, we're able to use the pre-market action, the pre-market tops, as an educated risk for anticipating the trade into the parabolic. So this isn't a trade for most new traders, but this is exactly what I'm looking for and exactly what I cover in Tandem Trader, where that morning move, in this case, this one had about 230,000 shares that traded in the first candle, first minute. I want to be reactive. I want to be able to anticipate that trade into the parabolic. Now, I could have been wrong. So, had I been wrong, I would have a plan. 6 over and under. If 6 starts to grind and hold, I need to start to think about covering if I have any size. In this case, I'm not trading a lot of size. I'm trading a starter entry. Then I need to be proven that it starts to retest, failed follow through momentum, and then go ahead and add into the winner. You can see exactly what I did here. I shorted right in the parabolic using that 6 as a guide, washed out, went ahead and locked some in, locked in another third, and then I went ahead and let the last quarter fade throughout the day. But keep in mind, you should never just short a stock because it's gapping up or it's going up. The key here is, just like VLTC in the last video that I did, I waited for that failed follow-through momentum to happen. Next question was, as you tweeted, do you think it's a good idea to scale in 100 shares at a time and build a good average around 1,000 shares or so for an account that is small? After watching guys like Jay Graham and AT09, I realized that they scale in many times. I tried this and I find it's much easier to find the top and have a good average, and it's much easier on the emotions too. And the question starts to relate to whether or not it's worth it with commissions. So I would never scale in 100 shares at a time if the full share size is 1,000 shares. I'd look for a third or a half of an entry. In stocks, for example, if I was trading 5 or 10,000 shares, I might scale in at max 2,000 to 3,000 shares at a time. But depending on the size of the account, if it's only 1,000 or 2,000 bucks, sometimes it's just good to go through the motions with the intention of making good entries and good exits and not necessarily trying to make money at this point. The key is to prove yourself that you're making the right motions and then slowly scale up as you've saved up money from there. it's very easy to get frustrated with yourself having a small $1,000, $2,000 account, trying to make it work, and your time could much better be utilized just educating yourself and learning and testing out new methods that you're starting to pick up on. Sticking with the theme, this is an extension of Tandem Trader. So with the questions that I receive, I expect that people have either watched Textbook Trading and Tandem Trader or are a current member and have questions that might have been related to recent plays. So last webinar, we went over the first part of this question. So I'm going to skip right to, you mentioned in the DVDs about breakouts or breakdowns and having to do with the volume. Are there any other ways to interpret the volume that help you pick entry and exit points? For me, it's seeing either big bids get hit and snap, only to reclaim that level and absorb slowly, grinding higher. So what I mean by that is when a stock starts to push up a little bit and then it pulls back and it's holding at, let's just say, $3.20, and then it retests 320, and then it snaps real quick. Bunch of volume comes in, and then all of a sudden 320 bid comes back. And then it starts to go to the next level, 330, and then jumps to 340, comes back, retests 330, might snap down to 326, 327. All of a sudden, big bids come back, or even just not even big bids, but small bids, but they reclaim that 330 level. As long as there's some type of staircase, some type of upside that continues to grind a little bit higher, this is what I'm looking for. I'm looking for that heavy volume that comes down, but the bids don't seem to care. They just keep on inching higher. Likewise, on the downside, I'm looking for a stuff move with higher than average volume where it may break out or push into a prior high, increase in volume, and then quickly sit back. So we talk a lot about that stuff move, the stuffing action. So any good push towards a prior breakout spot, or even if it takes out the high by a few cents. And this is why, for me, I like to use mental stops, because sometimes that's exactly what happens. If you use a stop that's based on the exact high a day, or if it's on a particular support level, sometimes it needs to test that level. It's not going to hold it to the penny. It might jump up and down a few cents, maybe 5 cents, and then it sits right back after a huge volume candle. So this is the case in a stuff move where it looks like it's about to break out. All of a sudden it goes, a bunch of volume comes in, and the reaction is not a breakout. It's all this volume came in and it didn't move. Now what? And so that's when you start to have that little push into that break, and then you have that quick red candle down as everybody's wondering, well, I just bought for the breakout. What do I do now? So KBIO ends up being a perfect example of that. And what we had done is pre-market, and of course this is a way too thin to alert. So this is more of an idea. But when the trend holds, especially after a big day like it had, so you can see that it had come up from 2, consolidated, pretty much put in a nice little base at 280s, ramped back up towards the 330s the next morning, and then settled off around 3. So is this a big move? When you look at the daily chart, obviously, it just had a reverse split. So it looks like, well, this thing was just $2 and now it's 330. So everybody gets excited. They think that it's a short. They think it's something to, bet that it's going to go down. And this gets them into a little bit of a situation by trusting that it should pull back. So for example, when it ramped up this day, we had a nice little short, just a reactive trade to the parabolic. It pulled back. Then you can start to see it held a double bottom, then a higher low, and then it started to ramp back up. And the volume followed with it. So there's probably a lot of people that were being patient, expecting that, hey, this thing's up on nothing, it should pull back. Just like on Friday, where it started to hold, the 320s held and the 330s held, starts to ramp up, parabolic at the open, pulls back, starts to consolidate. But all along, we have a good risk versus reward based off these 320 levels. Originally, it was off the 3s, then 320s, and then this starts to hold a higher low, can anticipate breakouts, so on and so forth. A lot of the fundamental shorters were on the wrong side of this trade on Friday. They ended up getting back to almost even, but not really. So you can see, the dips were getting bought up at whatnot, the 320s, 330s, and we kind of identified that. And then right over here where the area between 370 and 360, it kept on getting absorbed every time it came back under 360. That ended up being a nice little level pre-market that showed us, hey, if it holds this level, it's a good chance that it's going to continue on. So that was a nice little breakout and anticipating based on the dips and based on the absorption levels. But then later on in the day, you can see that, it kept on failing, lower highs, and it kept a steady downtrend. Even though it was battling for quite some time at the 435 levels, and even I had kept some on, I thought that this thing might end up having a nice little curl back. But this thing started to push back, and if I put on the VWAP, which I'm not even sure if it's going to work today. Good. Now you can see where it's pulling back, and once it snaps under this prior support level, the 430s, it starts to become not only the resistance, but it's also the area where the VWAP is, and that's usually the weighted average price where most of the stock is traded for that name. So you can assume that most people that were in it before, either short, long, whatever, their average is around this level, and it's going to be an area of potential resistance. And that's a perfect example of sort of that stuff move into the VWAP, retest, fail, and then sort of just faded off. So it's going to be an interesting one on Monday or Tuesday, since we have a long weekend. But that's both an example of the front side and the back side and what we're looking for, especially the stuff moves into the later half of the day. So the next question has to do with, can you help me understand the front side versus the back side of the move? And what are some key indicators that you use to say a stock is now reversing, failed to retest, lower lows, etc.? And what if the stock looks to be making lower lows, but the overall trend says it's moving upward? Are you going to be more patient at that point? So it's a very common question that I get. It's a very big thing that we go over and over again. The front side versus the back side of the move. And, there's sometimes the fundamental shorts that when a trade finally works out, they'll say, if you were confident, you would have short into the front side of the move, blah, blah, blah. But that's when you run into AQXPs. That's when you run into some of these major short squeezes. ACI, that was a no-brainer short where, there's no reason why it should be up here. And, all the fundamental shorts in the 2 to 3 range were pretty quiet in the 7, 8, 9, and almost 10 range. Or actually it did hit 10. So that's just something to always keep in mind, because you never know which one is going to do an AQXP, and they don't happen often. But with an attitude like that, for example, KBIO, this company's trash, I'm going to keep on adding. Like I said a couple times already, people were upside down at the 5, and look, this had a lot of volume. If this continued to hold this level throughout the day, and this ended up starting to ramp back up towards 450, 480, these guys would be in a bad position. So the key, and I'll give you 3 examples for finding the backside of the move, and it's not always that it's 100% guaranteed. It's never the case. What the backside of the move does is it gives you a place to be wrong, a place to use as a guide as your risk, so that in the event that you are wrong, you have a place to stop out. So, for example, KBIO, sure, you can start into parabolics on the front side of the move, but if you're starting into the front side of the move, you need to have some type of idea. And if that's a quarter size, a half size, whatever it may be, you need to be okay with the potential 50 cent to $1 spike against you. As you've seen, it can move pretty quickly. And same thing happened with AQXP and many others in the past. So the key is, if you're going to start, use whole $half marks to your advantage, kind of make a plan. So if you're starting into the 490s or the 5s, you might want to risk in your mind towards the 550 level. And a partial size, maybe even 6. And then once it exhausts a few times, you can go ahead and add into the pops, and then you have a set risk based off the high days. But for newer traders, what I like to look for is let it exhaust, let it push through that 5. Who cares? You don't need to nail 4.99 or 5 or whatever it may have topped out at. What you need to look for is when it rushes back down, pulls back, retests, and it fails. At that point, watch how it trends. And if it starts to retest that prior level, as it did right here, put in another top, this is the interest point for me. And I want to start to short pops and use either the recent high or the high of days, depending on how far it is off. So for example, if it was 6, obviously I'm not going to be looking to risk off the high of days. I want a better reward to risk ratio. But I want to look for pops and risk towards this level here, whole $0.50 mark. And then if I add in, I want to risk to the recent highs. So that might be 450s over and under, 470s, whatever it may be. But as you're adding in on the pops, your risk starts to come in a little bit and you tighten up that range. Rather than risking 20 to 30 cents, maybe you're risking 10 to 20 cents and then so on and so forth. And then you're risking to break even basically. Same thing happened over here on BVXV. And you can see here on BVXV where it's starting to parabolic. You don't know where the top's going to be. You just saw it go from 480 to 580. Why can't it go from 580 to 680? And so you can start to see the peaks and you can see the candles are kind of getting sold into, but still don't care. Now starts to push, fail, push again, fail. Starting to peak out at the prior spot where it had support. Now I care. And now I can risk either off the high days or the 6 mark as a whole and $0.50 mark, and then have a nice little pullback and fade. Same thing with this candle that we already went over. You can use the front side of the move's resistance as your guide once the market opens. One other quick example is after this AQXP had ran like crazy, you can see it starts to put in a peak and put in a peak. And as I said, it's not always going to hold things to a T. You can see that it broke through the prior top. But if you note the volume, as we discussed earlier, that's what we're interested in. So that big move, huge volume, and then lower high, that's the stuff move. And at that point, you can go ahead and short pops, risking based off this prior high. The last question that we have here is, must you wait for support to break or backside of the move for shorting pops? Or how do you add to a position successfully, assuming you got in on the right side? The easy answer is, if you have to ask, and no offense by this, then yes, you should absolutely wait for the backside of the move. And the reason I say this is because you should be able to make that decision on your own if you're going to be taking the risk and really the unknown risk of the front side of the move. We can all have an educated bet, but we don't know how we're going to react in the case where the stock continues to go. Do we actually follow through with our rules? Do we actually take it off? Do we add to our position? What do we do? And that is not for a new trader. Front side of the moves can be traded as long as 1, you're in partial size, 2, you've given yourself a wide entry plan and are anticipating the next whole or $0.50 mark, 3, you actually have a plan and you're not just throwing a dart, and then lastly 4, you have an exit plan if the stock continues to grind and hold trend. The next question is something that I've actually been working on more and more as far as adding into a position. The question is, I'm not bad at getting a good average on the front side in the morning, but how do you add to the position into pops? Like, how do you know it's a pop and it won't keep going to break the high of day? So this should only be done if you're on the right side of the trade. You shouldn't be adding into the front side of the move. So with that said, I cover this topic quite often in webinars, but it's best to add to a position by pretending that you are not in the stock yet. Would you be chasing the entry if you weren't in? Probably not. So you look for an entry that you'd be okay with, whether that's on the short side, you're looking for pops, or whether on the long side, you're looking for dips. But the key is to pretend that you don't have a position yet and then add or take the position based on what you see currently, rather than, hey, you know what, I'm up a lot, I'm just going to go ahead and add randomly. I'll add a little bit more, I'll add a little bit more. And I think that you'll be a lot more happy and have a lot less emotions involved if you go ahead and just pretend that you were not in the stock yet. And last but not least, I've seen screenshots of many traders enter into the morning parabolic and then add into the next pop or bounce. I keep putting pop in question marks because I don't fully understand the definition of them or how to identify them during the trade. Hindsight is 20/20. Then, how do you know when it's time to start scaling out rather than still adding? So, morning parabolic is a great trade if there's heavy volume. Stay away from the thin ones and crowded names. If everybody's bashing it and they're short, everybody you look on Twitter, short, but it's still going up, think about it. All those people at some point are going to need to cover. So when it starts to pull back towards where they're even at, there's going to be some type of support level where they might start covering. Much like the BVXV example or the VLTC example, where you look for a rebound in the failed follow-through momentum setup as covered in Tandem Trader. And as far as scaling out, it's really up to you on what your trade was. For new members, I always suggest to go ahead and lock in. Don't wait for the home run trade. Don't wait for 9 a.m. to 4 p.m. You know, if you're up a couple $100 and this is new to you and you're trying to build your account, take it. Take it. Because at the end of the day, it's about compounding what's in that account. And the further away that you get from your starting equity, the less emotions you're going to be involved with, and you're going to be able to give yourself the best shot.